So in this video, what I'm going to do, I'm going to bring all the previous ideas that we've learned and I'm going to put them all together in one sort of entry scenario. And this is going to be the scenario that we look for to enter the market 90% of the time. So to start off with, what I will do, I will utilize an uptrend for this example. So let's say price has created an impulsive leg, we've created a retracement, create another impulsive leg and another retracement. Okay. Now we've created a third impulsive leg, and there seems to be a bit of a pattern forming here. We create an impulse, then we correct. We create another impulse, then we correct. Each time we can see that price is breaking structure and the low is failing to break the prior low. Okay, so take that in mind. Also, what we can see is this retracement was a nice deep retracement and retraced into an area down here. So from this, we can then start to build an understanding. Okay, what could price potentially do? Could price do the same thing, do a deep retracement, and then could we look to buy up from there? Absolutely. Now, there are a couple things that we need to look out for. So first of all, we need to look at institutional candles. So we need to understand that when institutions are in play, what they first need to do is they need to sell down to then buy up. Okay, and what they can actually do from this point is they will end up leaving certain clues in the market. So the first clue might potentially be imbalance. Okay. And if we do get imbalance, we know that the institutions are definitely in play. Why? Because institutions are the only market participants that can create imbalance. So in this example here, just going to adjust it a little bit. Perfect. So in this example here, what can we see? We can see our impulsive move, which is signified by these bullish candles. We can see a prior high that has been broken up here. So that has been broken. And effectively what we're doing is we're wanting to build a picture, understanding that previously price has retraced quite deep. So what we're looking to do is we're looking to buy. Now, we can see some imbalance here. And our understanding of imbalance is that at some point it needs to get filled. Now, does that make sense for price to then come and fill it on a retracement? Absolutely. So we now know that. Also, the next thing to understand is, do you have an institutional candle? Now, what is an institutional candle? An institutional candle is where the institutions, they sold off to buy. And we can see that here. So we can see the selling started at the open of this bearish candle. And then what we can see after this bearish candle finished, we can then see an impulsive move created, which has then broken this prior structure. Now, what you have to understand about this scenario here is that the institutions, they still have their sell position open. So when they sell down, they buy straight back up. They're still in their sell position, which is in a huge amount of drawdown. And at some point, because they trade with no stop loss, at some point they need to return price to that level so they can get out of that sell position at break even. So understanding this scenario here, we now know there's two reasons for price to come back down to this level. So first, we've got the imbalance fill, and next we've got this institutional candle. Now, as price then filters down into this level, what we can do is we can see the open of this sell candle. And the simple way we'd play this is we'd put a buy limit on the open of this sell candle and we'd put our stop loss below the low. Reason being, because when price breaks below this low, this is the low that created the high. So if price breaks below this low, we're in a downtrend. And this is the invalidation point. So understanding that once we then retrace into this area, we've filled the imbalance, and we've hit the open of this institutional candle. Now, what happens at the open of the institutional candle? Well, with our understanding, if the institutions have opened their sell positions from this level and they're in drawdown and they want to get out of that sell position at break even, they at least need to return it to this point here. Okay. And what happens when price returns that point? They get out of that sell position at break even. So all of that selling pressure just disappears. And now there's only institutional buying pressure. And when there's only buying pressure, what do we expect price to do? Boom. Price moves to the upside because there's only selling pressure and we create another impulsive move. So this is the way you'd play that. You'd then target this high, because if we create a higher low here, so a low that's higher than here, we can almost expect a higher high to be created. So the safe target is the top of this range. So in this scenario here, we only have one institutional candle, reason being because this is the last down candle before this significant up move that broke this prior structure. Now, how would it look if there was a down candle in the middle? Well, let's draw out an example. Okay, so this is our next example. What we can see is we can see two institutional areas. We can see this last down candle before the significant up move that broke this structure, and this as well, okay? What would we do in this situation? So first of all, we've got to understand that we can still see imbalance, and we still have an understanding that the imbalance at some point will need to get filled, and it still makes sense for the imbalance to get filled on this retracement down. So this is why we wouldn't pay attention to this point. Now, if there was no imbalance at all, this is when we'd use this first point as a target. So let's say we've created a wick down here, and we've got a wick up the other side. So we've got no imbalance at all. So this imbalance here is completely gone. At this point, we then use the open of this candle as our potential entry point, and then we'd use the bottom of that as our stop loss. Okay. Reason being because there's no imbalance, there's no reason for price to come down here to then fill an imbalance because there is none. So this becomes the first institutional area that we look to potentially trade off. Now, does that mean that price will react off here? No, not necessarily. But with our rules, we have to use this first area to potentially trade off. Now, with this scenario here, the chances are that your risk reward is going to be significantly less than if we got deeper retracement into this candle. So what you can actually add into your rules is when you see a scenario like this, and there's a bearish candle above the bottom point of interest, we can just ignore that and we can only look to trade off the bottom point of interest. So now let's have a look at a bearish scenario. So a scenario that we'd look to potentially sell from. So first thing to understand is that we're in an uptrend here. Now in a sell scenario, we'd want to be in a downtrend. So we would want to be creating lows, lower highs, lower lows. Now at this point here, we've got to analyze price. We've got this low that's been broken. You've got the high that created this new low. So this is going to be our trading range from here to here. So at some point in this area, we could get a retracement. It could be at this level. We could then get a movement. Or alternatively, it could be a deeper retracement and we could get a movement from up here. So what we have to do is we have to now build a picture. We understand that we've broken structure. So we're looking for a potential entry at some point in this area here. Now, let's say we've got some imbalance and we also have an institutional candle here. So when we're selling, the institutional candle would want to be a buy candle. So the last up candle before the down move that broke structure. And at this point here, with our understanding that imbalance needs to be filled, and we've also got an institutional area up here, what we need to do, set a sell limit at this area, and then we'd also have our stop loss above the high. So this is our invalidation point, which means that if price was to move above this point, we'd actually then be in a bullish scenario. So we've got imbalance here. We understand that that needs to be filled. We've got our institutional candle. So where the institutions have bought up and then sold off, and they're still in the buy position. So what they need to do is they need to return price to this level to get out of that buy position at break even. So we see price move up, sell limit. This position gets mitigated. So that means they close their buy position out at break even. It means there's only selling pressure left and we see an instant reaction. We target the downside, easy. So from this video, I hope you guys understand how we put everything together and we now have our institutional trade setup entry system, okay? In the next video, I'm actually going to dive a little bit deeper into how you can increase the strike rate of this setup,